Hello, everyone. Paul, the virtual investor here. And today I want to talk about mortgage rates dropping this past week and rather dramatically amid all the bank failures. And as to answer the question, is now a good time to buy real estate? Whether you're a first time home buyer looking to move from one location to another now that interest rates have dropped a little bit, or whether you're an investor looking to get in, whether it's your first or whether you're a seasoned investor and you're questioning, should I buy more real estate right now or should I sit on the sidelines? We're going to dive into that all, and we're going to talk about what is going on in the market and why things are so volatile and what caused the rather dramatic drop in rates this week. So the big thing, there's a good article here, CNN Business, mortgage rates drop in wake of bank failures. So with SVB and others failing this week, there's what's called the flight to quality, where people go from the equity markets to the bond markets, to government bonds. And so the 10-year treasury rate is what the 30-year mortgage rate is based off of. And it dropped from 4% to 3.4% by midweek, a really nice drop in rates. So that brought the rates down from, I think it was around 6.73% this week to 6.6. And I anticipate this is going to slide will continue here, at least for the short term. And we'll see if things mellow out. And the reason I think it's going to be more than just a short term, and why I think it's a great time to buy, is because we're heading into rather uncertain times. And I think this bank failure could be a contagion that expands. It's already going on across the world, not just here in the United States, but across the world. Let's talk a little bit about why it happened. So the biggest reason it did happen, there's multiple reasons. One, just bad business and bad people running these banks. Some of these banks are termed woke banks, where they're politically correct and not doing the right thing by their shareholders or the right thing to make sure the business is profitable. So they were investing in these treasury bonds, longer and shorter term treasury bonds. And as the rates are being aggressively raised by the Federal Reserve, the short-term rates now, this is your short-term, your prime rate, is being aggressively increased. The value of the T-bonds are going down. The treasury bonds, the yields are going down. So their investments are now worth 80 cents, 70 cents, 60 cents on the dollar, which really made them pretty much lose so much liquidity out there that they were forced to either going to go into bankruptcy or had another bank pick them up really cheap. And that's basically what happened. Another bank picked them up very inexpensively, pennies on a dollar. And this was the 16th largest bank in the United States. So it's a pretty good sizable bank. Signature Bank, I believe, was another one. Same thing happened with them. Again, when you have bad people and bad business practices running these banks, this is going to happen. And I expect this contagion to continue because of bad political choices, woke culture, all that kind of stuff is a factor, unfortunately, in a lot of these bank failures. And is your money safe in a bank? That I don't know. I imagine big banks like Chase, Citi, Wells, Bank of America, they'll probably be fine. They'll probably be deemed too big to fail and will be bailed out, just like other banks have been bailed out here. So what I think is going to happen is rates will continue to drop. Mortgage rates, 30-year mortgage rates, right? The 15, 30-year mortgage rates will continue to drop, and therefore to be a good time to buy over the next maybe 3 months to 6 months max, before things could get worse. Unemployment could be a factor coming in after that. All kinds of different factors, war expanding. There's so many different things that could affect these rates in a positive or negative way, meaning they'll go up or they'll go down. But the way I see it here over the next few months is I do expect rates to continue to go down. Great time to buy, great time to rehab, refinance your rentals, refinance your property, your primary investment. But if you're looking to buy, it might be a great time. Your first time home buyer. A lot of millennials have been on the sideline, and Gen Z, young Gen or older Gen Zers who are able to buy properties. They've been sitting on a sideline with the higher rates. And as rates get into the fives, I think you're going to see a spur of home buying, despite the fact we have really low inventory. So because of that, I think it'll keep pricing pretty stable. And again, your home buyers aren't buying homes based on price. Let's put this all into perspective. You're buying your house based on the monthly payment. So if you can afford a $300,000 house at 8% or 7%, let's call it, right? But barely, and you're not real comfortable and your rent's a little bit cheaper, maybe you're gonna stick with the rent. But if that drops to 5%, you might be all over that because your payment might go from, call it 2,000 a month down to $1,400 per month. And that makes a huge difference in your affordability. And when you're locking in over 30 years, when you know you're locked in low like that, and think about the inflation rate, what we have going on now with that lower payment is going to help you tremendously with inflation going up in different markets, because you're locking in a rate. Whereas if you're renting, you are not locking in a rate, maybe from year to year, or maybe you have a 2-year lease if you're in a residential property, but you're not necessarily locked in long term. So there is a lot of risk. And if rates go down and inventory stays low and there's not a whole lot of housing, rents are going to climb again. And rents will also climb if rates go up, because people can't afford. Inventory would end up increasing at that point. Even if it's not drastic, it'll increase at that point. And rents will end up going up because the affordability factor. It's all about the affordability. And we've really kind of hit our peak in the affordability of home buying and renting. I just don't think there's much room for either to go up. So if rates were to end up creeping up and going up over 8%, which is the historical average in the United States throughout history, then what's going to end up happening is people aren't going to be able to afford it. Rents will end up going up, even though it's pushing people beyond their means, especially with inflation, cost of food, cost of fuel, cost of living, everything. And people's lifestyles are going to change. So consumer spending will drop. Everything's going to drop as far as what a consumer spends on, whether it's technology, whether it's meals out. So then you have restaurants. You just have this domino effect of layoffs. And then again, that further exacerbates everything and makes the whole thing worse. But that's worst case scenario, right? I don't see that right now. And I think we've got an interventionist government at this point. And whenever things get bad, whether it's unemployment or whatever, if unemployment got really bad, they would think nothing of rolling out universal basic income, right? Because they've proven they are going to spend like drunken sailors. And if they're spending like drunken sailors, they're going to give universal basic income. And what is that going to do? It's going to make inflation go up more. What caused this whole mess to begin with? COVID, all that free money coming out, the helicopter money coming out, record low interest rates, caused people to gamble and just push the prices of everything up. We're the benefit in real estate side, prices getting pushed up. Again, though, it's about your monthly payments. So if you bought, even if the prices values go down over the next few years, your monthly payment's going to stay fixed unless you're in one of those short-term mortgages or adjustable rate mortgages, ARMs, which I never recommend to anybody, despite the fact that you think you may be moving in 2 years. You don't know what's going to change. Always lock in long-term, as long-term as you possibly can, because you just don't know. Don't worry about saving a couple of bucks up front. You could save yourself a ton on the back end. But this is what I feel is going to be going on. So I think now is a great opportunity to buy, at least for the next 3 to 6 months, refinance. If we see rates start to take off, increase, then you're going to have to back off. Everybody's going to have to back off. Home buyers will be the first to back off. Builders will be backing off, and tenants or landlords will be looking to pick up more properties to then rent out, because rents will be increasing. But we have an inventory problem. So with the inventory problem, it keeps pricing fairly stable in markets where people want to be. Again, we talk we talk a lot, and I talk a lot about past videos of where people are moving to and where they are leaving. So factor that in with this whole conversation we're having here today. But just know that I think right now is a good time, at least in the short term, the next 3 months to 6 months max. I am worried about the fall. I don't know what's going to happen in the fall as far as rates. But what I'm seeing right now with this contagion going on all around the world and turmoil, I think now is actually a good time, despite the fact that we have chaos going on all around. So hopefully this helps you. And if you are thinking about buying your first home, watch these rates as they continue to fall. And if they continue to fall even more, don't forget you can refinance these properties. So if you buy at 6% rate and the rates drop to 5%, generally that 1% rule, if you're refinancing at 1% less than what you did before, it's worthwhile. You'll pay that off in a few years, 3 to 5 years, that difference in what your closing costs and all the cost of the appraisal and all your costs of the refinance would be. All right, guys, hope that helps, and we will catch you on the next video.